In this lecture, I want to talk about selling or shorting iron condors. And I want to begin with a chart of Amazon to kind of give you an intuitive way of understanding iron condors, especially short iron condors. So here's a daily chart of Amazon. We can see for the last couple months it's been range bound between roughly 1840 and 1700. So let's say that we want to bet on the stock on Amazon remaining range bound over some period of time, maybe over the next 30, 60, or 90 days. Well, one way to do that, as we've seen in previous lectures, is to do a short strangle. And the way we would do that is we would sell to open a call at the top of the trading range, so sell an 1840 call, and then sell a put at the bottom of the trading range. So we could sell a 1700 put. And what this short strangle would basically be a bet that the stock would not go a lot above the top of the range or a lot below the bottom of the range, using those positioning those short strike prices right at the edges of the range. Now, what's the problem with the short strangle? It can be a great trade, but what happens if after you put this on, the stock goes way up or it goes way down? In that case, you'll start to lose money. So one way to deal with this is to protect the wings, protect the upside, and protect the downside. So we could sell the 1840 call, that would be fine, but maybe we want to cap our risk by buying a 1900 call. So we'll buy a 1900 call, so that way if the stock moves up, we will stop losing money right at that 1900 level by buying this call. So we're basically short a call here, long a call here to protect against a melt up in the stock. Likewise, if we are short a put, this is great if we think the stock is going to bounce when it gets down here, if it's going to bounce off this level. But what if the stock keeps moving lower? Well, in that case, we've got some downside exposure. And we're short a put, so we could have the put assigned to us. We could be assigned a long position in the stock. We could start losing money. So how would we protect against the stock really falling off a cliff? Well, we could do something similar to what we did. At the top here, we bought a long call. So what we could do at the bottom is we can buy a long put, and that will cap our losses at the on the downside. So basically, one way of looking at this is you've got a short strangle in the middle here, and then you cap the wings by buying a call and buying a put. That's one way to look at it. The other way to look at it is you could see these top two calls as a short call spread, and these bottom two puts as a short put spread. But I like to think of it, I really like to think of it as a strangle, where you're betting that the stock's going to stay within this range, and then you cap your losses above a certain point and below a certain point by going long a call up here and long a put up here. So that should just give you sort of the intuitive feel for this. Let's drill down a little deeper now. So as we said, being short an iron condor or selling an iron condor, it's a lot like being short a strangle, but capping the risk on those wings. So another example, stocks at 100, we'll sell a slightly out of the money call. At 105, we'll sell a slightly out of the money put at 95. There's our short strangle. And then we're going to cap the wings by buying a 110 call and buying a 90 put. In an iron condor, you normally use the same expiration for all the options, usually 30 to 60 days out, so you really benefit from the time decay. And the way you would talk about this is you would say, oh, I sold the February 2020, that'd be the expiration. I sold the February 2020, the 90, 95, 105, 110 iron condor. You're telling people you're selling it, so we know that you basically shorted those inner strike prices, the 105 and the 95, and then you bought the wings. But that's basically how you say it. As we said, selling an iron condor is the same as being short an iron condor. Those terms are used interchangeably. It's used for range-bound stocks, and as such, it's basically a market-neutral strategy. It at least starts off as being market-neutral. And then over time, if the stock moves up a lot or down a lot, it can become less market or delta-neutral. It's used for range-bound stocks. Great way if you think a stock's just going to kind of chop around within a range, a great way to sort of monetize that and create some current income. What's also nice is that we limit our risk by buying those wings, by capping our upside and downside risk. So it's a limited risk strategy, which appeals to a lot of traders. And it's also great for people who want to generate income. And as a result, selling iron condors is a very popular trade for both beginner option traders and advanced option traders. Just there's a lot you can do with them. And it's fun because you are capping your risk on either side. Because it's a limited risk strategy, you can maybe allocate more capital to it than you normally would. And you can sleep better at night knowing that if the stock crashes or melts up or gets taken over, that you're still going to be okay. You know your maximum possible loss at the outset. As we said, another way of thinking about a short iron condor is you're selling an out-of-the-money call spread, which is bearish. You're betting that the stock's going to stay below that level. And you're also selling an out-of-the-money put spread, which is a bullish move. You're betting the stock's going to stay above that level. As a result, you're sandwiching the stock between these two credit spreads, and you're betting that the stock will stay between those two spreads and hence will make money if it does. And I should mention that both these spreads, the short call spread and the short put spread, are credit spreads. We profit when we enter them. Now, basically, we already went over this, but basically you're selling a call spread on the top, selling a put spread on the bottom, and normally doing this 30 to 60 days out. So let's use an example. Let's go to Robinhood and check out an example right now. We already saw the Amazon example, but let's pick a real-time example. Here we have General Motors, GM is the ticker, and you can see that it has been range-bound, really between the 35 level and the 40 level. And it's been trading within this range. It's made brief excursions above the range and below the range, but it hasn't stayed out of that range for very long. And so if we wanted to do a short iron condor in this position, what we would do is we would sell the 40 call. We would sell the 40 put. We would sell the 35 put right down here. And then we would buy a put at 33 to cap our downside. And we would buy a call at 42 to cap our upside losses. And so basically what this would look like on Robinhood is we would sell the 35 put and collect $1.43 for that. We would buy the 33 put, more out of the money put, and pay a debit for that, 76 cents. Again, as we mentioned, we are going to sell the upside range here. So we're going to sell a 40 call, and then we're going to buy a 42 call to cap our losses in case the stock moves up a lot. You can see that the total credit for this, if you add all these up, basically you're collecting money from selling calls, you're paying to cap your risk on the wings by buying that 40 call, and buying the 42 call and buying the 33 put. As a result, you end up almost always with a credit. In this case, the credit's going to be 85 cents. Your max profit on this trade will occur if all the options expire worthless. In other words, if the stock stays within that range and none of the puts or calls are in the money at expiration. So they all expire worthless. You collect 85 cents on this, use the multiplier of 100, and so your maximum profit on this trade is $85. Now this is fairly normal, especially if you don't choose a super volatile stock, which pays you a little bit more premium because implied volatility is higher. But something like GM, not a super volatile stock, certainly compared to a stock like Tesla or Beyond Meat or something like that. And so you don't collect a huge amount of premium much of the time. Now you can adjust these strike prices to collect more premium, but don't be surprised that this premium is fairly low. We will see that you can make adjustments. You can use a more volatile stock, for example. You can also adjust the size of the wings and the size of the short strangle in the middle. But basically our max profit will be if all the options expire worthless. We'll make 85 cents, which is $85 when you use the 100 multiplier. Our max loss is just going to be the width of these two spreads. So the put spread has a width of 2. The call spread has a width of 2. In this case, both the spreads have the same width. So we're just going to take that width, and then we're going to subtract the premium that we collected, the 85 cents. And so that gives us, $1.00, $1.15. That would be our maximum risk. So our maximum risk in dollar amounts would be, you just multiply by 100, it would be $115. That would be our maximum risk on this trade. So we're risking $115 to make $85. And again, it's very easy to change these parameters by adjusting the width of these spreads. So let's go back and just pursue this a little bit more. So a short iron condor, you can see it's got that strangle in the middle, and it's got the two wings. I want to compare that to a short iron butterfly, just so you don't get the two confused. Short iron butterfly, if we were doing, well, let's go back for 1 sec. So the short iron condor, let's say the stock's at 100. We're going to sell the 105 call and buy the 110 call. We're going to sell the 95 put and buy the 90 put. So we're going to put on those two put spreads. Now, what if we wanted to do a short iron butterfly on the same stock? The stock's at 100. In that case, it's basically in the middle of the structure. Rather than there being a short strangle in the middle, there's going to be a short straddle. So basically, we would sell two at the money options. We sell the 100 call, we'd sell the 100 put. That's our short straddle. And then we would buy the wings to protect ourselves in a similar manner to the iron condor. This is an iron butterfly, and so it's got that short straddle in the middle. And then we're buying the 105 call and the 95 put to protect the wings. So just to recap, short iron butterfly, it's a short straddle with the wings capped on the risk. The risk capped on the upside and downside. A short iron condor is a short strangle with the wings capped. Ultimately, once you start trading options, you won't really have to worry about the names of these structures. You'll begin to build your own structures, and sometimes you'll build an option structure and you won't even know what to call it. You'll just know that I'm long this put and short this put and long this call, and they'll be different. Maybe they're not even balanced. You're short 2 calls and short 5 puts. So ultimately, the names don't matter that much. What matters more is your intuition of how the stock's going to move and how you structure an options play around that. As we said, the max profit on a short iron condor is just that credit you receive, that 85 cents in the case of GM, times 100. And that max profit, again, will occur if the stock is within that range. So at expiration. So for General Motors, we want the stock to be within the range right here at expiration. Likewise for Amazon, we'll make money if the stock is anywhere in the middle here at expiration. Max loss occurs. The way to calculate your max loss is just to take the widest spread, whether it's the short call spread or the short put spread, take that width of those strike prices and subtract the credit that you received and multiply that by 100. And this will happen, this max loss will occur if the stock is at or above the long call strike or at or below the long put strike. And so you can see, if we go back to our diagram here, this will occur if the stock is up here or down here, if it's outside of the range. Now the upper break-even price is just going to be that short call strike plus the credit received. That's sort of your cushion. Lower break-even price is just that short put strike minus the credit received. And the nice thing about iron condor, which bears noticing, is that you can only lose on one side of the trade at the time. So it's kind of nice you're collecting premium on the downside and premium on the upside. If the stock goes up a lot, you're going to lose money on your short call spread, but you'll make money on the short put spread. If the stock goes down a lot, you're going to lose money on your short put spread, but you'll make money on your short call spread. So this is nice. The stock can't be simultaneously really high and really low. So that's one nice thing about an iron condor, is you're kind of boxing it in and making money on both sides of it. Now, what happens at expiration? If the short call is in the money at expiration, you will be assigned a short position of 100 shares of the stock. But if the short and long calls are both in the money, in other words, if that short call spread is in the money completely, that short call and the long call will cancel each other out. You'll get 100 long shares from the long call. You'll get 100 short shares from the short call. They'll neutralize each other, and you will, as a result, you will not be assigned a stock position at all. But if just that short call is in the money at expiration, you'll end up being short 100 shares of stock. Likewise, on the downside, if that short put is in the money at expiration, you're going to end up being assigned 100 shares of the stock, long 100 shares. But if the short and long puts are both in the money, they will cancel each other out, and you will not end up having any position. Again, as with iron butterflies, there's really no reason to ever hold into expiration. I like to exit my short iron condors at least call it 5 days before expiration, sometimes even sooner if most of the juice has been sort of squeezed out of the trade and I'm close to my max profit. Assignment risk bears repeating. Even before expiration, when you're short options, you can obviously be assigned a position. So for your short call, if that short call is in the money, you can be assigned a short position of 100 shares of stock. If that short put is in the money, you can be assigned a long position of 100 shares of stock. Again, this will only happen if the long options, the long call and the long put, are not in the money. So if those two credit spreads are in the money, then you don't have assignment risk because your short call position will cancel out your long call position if you're assigned on each of them. Now, normally, early assignment risk only happens if that short option is pretty deep in the money and you're close to expiration. In other words, that option has very little extrinsic or time value left. At that point, because this is a short position, the short iron condor, you're usually better off having already taken profits on the iron condor and not risking assignment. Again, assignment is not something really to worry about, but just something to keep an eye on. And you'll get a feel for this just the more you trade iron condor. So when you first start trading them, start really small, and you can sort of see all the moving parts and sort of see how they fit together. Now, what do the Greeks look like for a short iron condor? Well, just like a short strangle or a short straddle, they're usually the delta of the initial position when you first put on the short iron condor is going to be close to zero. Usually you're going to be doing this, you're going to be sort of balancing the iron condor, positioning it so it's symmetrical right around where the current stock price is trading. So in the case of GM, we put this on when the stock is kind of at the bottom of the range. That's a little bit unusual. There's nothing wrong with it. You can certainly do it. Amazon would be a better example here where the stock is, a little bit closer to the middle of the range. So normally the call spread and the put spread are going to be arranged symmetrically and equidistant from where the stock is currently trading. And as a result, you're going to have a delta very close to zero at the beginning if that stock is pretty much right between the two, right in the middle between these two short option strike prices, the short call and the short put. Gammas can be negative, just like for most short positions like the short straddle and the short strangle. As the stock rises, a short iron condor is going to become more short the stock, more delta negative, and it's going to become more long the stock as the stock falls. So you can see by this that it's got a negative gamma, that the shortness or longness of it moves inversely to the direction that the stock is moving. A short iron condor is a theta positive position, meaning you make money from time decay. You're short those inner options. They will decay faster than or they'll have more value than the outer options. And they'll usually decay, I would say they'll decay faster as well. So overall, even though you're long the two wings, you will make money from time decay. Again, like a short straddle and short strangle, the vega of a short iron condor is negative. And so basically, if the implied volatility has moved up, that means that option prices have moved up, sort of by definition. Your short option prices, and so you're going to lose money if implied volatility moves up. Now, as we said, you can sort of position your iron condor in different places relative to the stock. A balanced iron condor would be where it's sort of symmetrical. The wings of this bird, this iron condor, are equidistant from where the stock's trading. So if the stock's at 100, you're going to sell the 105 call and sell the 95 put and then buy the wings. This can be close to delta neutral. And it bears pointing out that you can make those wings, in other words, the width of the call spread and the put spread, you can make them as narrow or as wide as you want. At the end of this video, I'll have some guidelines, sort of beginner guidelines, but ultimately it's up to you. You can decide, you can basically, what I like to do is I like to see how much premium I'm collecting, what my potential maximum profit is, what my potential maximum loss is, which is really a function both of the width of the wings and how much premium I've collected up front, and then I go from there. So the more you do this, you'll get a feel for it. It can be more of an art than a science. Now, what happens if you take your iron condor and make it very, very, very narrow? If you do that, basically the short strikes become the same and you're short an iron butterfly. You've got a short straddle in the middle there. So that's one way of thinking. You can think of an iron condor collapsing in on itself and becoming a short iron butterfly. Now, what would a skewed or unbalanced iron condor look like? Well, in this case, we're going to still do it symmetrically around the stock price. We're going to create a skewed bullish iron condor, short iron condor. Stock's still at 100. And what we're going to do is if we're bullish, if we have a bullish bias to the stock, rather than selling an equal number of calls and puts, we're going to sell fewer calls and more puts. So in the previous example, we basically sold one 105 call and we bought one 110 call. We sold one 95 put and we bought one 90 put. So in each case, we're just doing one contract for each strike. If we want to create a bullish skewed iron condor, maybe we would sell 5 of the 105 calls and buy 5 of the 110 calls. And then we'll sell a lot more puts. Sell 10 of the 95 puts and buy 10 of the 90 puts. So we're basically betting here that the stock has more of a tendency to rise or fall. We wouldn't be selling a put spread if we thought the stock was going to fall. And as a result, these kind of skewed iron condors, this one is skewed bullish, so it's going to have more of a positive delta. Likewise, if we want to create an iron condor, a short iron condor position that's skewed bearish, we'll sell more of the calls. So in this case, we sell 10 of the calls in the call spread, and we only sell 5 of the puts. And so this will be skewed a little bit more bearish. It will have a negative delta. Now, where do you start when you're just doing iron condors? A good place to start is to stick to expirations that are roughly 30, 45, 60 days out. So that will be the where you're going to be looking at for your the month to sell your calls and puts and buy your calls and puts. A good place to start for beginners is to pick your short call strike. Pick a short call strike that has a delta of about 16 or 0.16. And pick your short put strike that has a delta of about 0.16 as well, or minus 0.16. A reminder, a 16 delta or 0.16 delta means roughly that there's a 16% chance of it expiring in the money. Now, we don't want the options to expire in the money. And so let's, I've actually got a chart of the normal distribution here. So here's your standard normal distribution. Stocks don't follow this strictly. Stocks tend to have fatter tails on either side, but we're going to ignore that for the purposes of this and just assume a normal distribution. It's a fair approximation. And what happens if you choose a 16 delta, what's going to happen is that you're going to end up with, in the middle here, with a 68% chance of the options expiring worthless. The odds of them expiring in the money on each side are going to be roughly equal to the delta, so 16 delta on the upside, 16 delta on the downside, and this is what's called a one standard deviation iron condor, where you're basically selling the short options one standard deviation out, which means those tails only have a 16% chance roughly of expiring in the money, and that means that you've got the bulk, you've got one standard deviation on either side in the middle here. So 68% chance of the trade being profitable. Again, it's an approximation. Stocks don't always work perfectly this way. But this is a nice place to start, especially when you're doing this in a test account or with a small amount of money. Pick your short strike to have a delta of 16 for the call and for the put. They should both have a delta of 16. That way your entire iron condor has about a 68% chance of expiring worthless. One standard deviation. And you can see if you use 68% plus 16% on the left side, plus 16% on the right side adds up to 100%. And then you can cap your risk on either side by buying a 5 delta, buy to open a 5 delta call, and buy to open a 5 delta put, which will obviously be further out of the money than those 16 delta short call and 16 delta short put. You can also experiment. You could also use a 25 delta for your short call and your short put. What this will mean is a slightly smaller trading range that you'll allow the stock to be in at expiration. And so there'll be a lower probability of the trade being profitable, but you will collect more premium because you're selling options that are closer to the money. So play around with the delta that you use. Play around with how wide the strikes, the protective call and put are, how wide those the short call spread and how wide the short put spread are. You can play around with that, look at your risk reward, and pick something that works for you. The more you do this, the more experience you'll get. If a stock is, if you're collecting a lot of premium, maybe you can afford to cap your risk on either side a little tighter. If you're not collecting as much premium, maybe you have to go a little further out. But a lot should be based on where you think the stock's going. You should at least have a good idea that the stock's going to stay range bound. So just to recap, just like a short iron butterfly or short straddle or short strangle, for a short iron condor, we make money two ways. From theta decay, from time decay. We want time to pass. We want the options to decay, especially that short call and short put. And we also want the stock to stay range bound, since a short iron condor is a gamma negative position. And so if the stock breaks out of that range, if implied volatility increases, we're going to lose money. So we want basically time to pass, we want theta decay, and we want implied volatility to stay level or to fall. In other words, we want option prices to stay about where they are or to fall. And that's how we make money. If the stock breaks out and starts trending, you're definitely going to lose money. So never sell an iron condor in a stock that you think is going to break out one way or the other, or has a reasonable probability of breaking out one way or the other. If stock starts trending higher or lower, it's going to blow up the structure of your iron condor. In a later lecture, we're going to talk about some of the adjustments you can do, how to repair an iron condor, especially a short iron condor that's gone badly. But it's better to have the trade be correct from the outside and not have to do adjustments or repairs. So that's basically how short iron condors work.